At one time, July 2019, Elizabeth Warren made the following statement: Sears, private equity, Toys R Us, Gymboree. It's not just retail. Warren stated that the collapse of such large retail brands as Shopko, Toys R Us, Sears, and Gymboree is due to the actions of private equity firms. Whether or not Warren actually believes this is unclear. However, we will take a closer look at all of these claims. This is a money mechanics video. If you like the video, please subscribe to our channel and remember to click on the bell icon to receive notifications about new videos. When thinking of Wall Street, many may have big banks, hedge funds, traders, and possibly some fictional characters such as Gordon Gekko or Jordan Belfort come to mind. However, outside of the financial industry, it is likely that few people have heard of private equity, and there is good reason for that. For most companies not going through an economic downturn or creating new ways to achieve high returns on investment or hosting wild office parties after a great year, the news media will generally ignore them, and private equity fits neatly into this category. Private equity can be explained simply as follows: using funds to purchase ownership in another business. The same concept applies to purchasing shares in the stock market. A private equity firm will purchase either a majority or minority interest in a privately held company. However, generally speaking, private equity firms would prefer to purchase a majority interest due to a major advantage: having control of decision-making at the company level. A very key point about the private equity firms who are acquiring these companies is their investor base. If a private equity firm were to acquire a minority interest in a company, the remaining shareholders, majority, could potentially make poor management decisions and ultimately lose the value of their investment. Private equity funds generally operate as limited partnership entities. In addition to limited partners that invest the majority of the money in the fund, the general partner, GP, invests a relatively small percentage of the total amount of money invested by the GP's firm, typically in the range of 3% of the total amount of money invested by the GP's firm. As for fund sizes, on an average basis over the past year, there have been roughly $600 to $800 million sized buyout funds. However, recent trends have increased the average fund size of buyout funds to near $1 billion. These large private equity firms therefore have the ability to spend hundreds of millions or even billions of dollars in order to purchase other companies. You probably think, these are wealthy investors that have access to money that you and I don't have, correct? However, the opposite is true. Yes, some wealthier individuals do invest in these investment vehicles. However, the majority of the money invested into them comes from pension funds, labor unions, university endowments, etc., all qualified investors. Why are private equity funds so attractive as investments? Due to their strong returns on investment. They frequently exceed the S&P 500 performance, which is why they tend to be of interest to people who have access to money to put into them. Typically, they generate returns in the range of 15% and 25%, but it's how they achieve this that is particularly interesting. Think about this way. You are going to purchase a home. You will make a down payment on the home of 15%. The remaining amount will be financed through a mortgage. You are not planning to live in this home. Instead, you will rent this home out. Your rental income will cover all of the costs associated with owning the home: property taxes, utilities, mortgage. In essence, you are the new owner of the home, but at the expense of the tenant who is paying their rent to you to finance your ownership of that home. Private equity operates on this same principle. So, when the fund raises money, that money will typically only be used to purchase a portion of the firm that the fund wants to buy. Think of this money as being like a down payment on the firm. So 40 to 50% of the firm is purchased with the raised money. Then the remaining portion of the firm is acquired through leverage, debt. We also know that private equity firms typically purchase profitable companies, which allows them to take some of the money that would have been applied to profitability to apply it to paying off the debt. To illustrate this further, let's say I purchase a firm earning $2 million in profit for $10 million. And I have to borrow $6 million, which leaves me with $4 million in cash. I can utilize the $2 million in profits to reduce my $6 million debt over the course of 3 years. At that point, I can sell the firm for $10 million and generate a profit of $6 million. This illustrates the concept of a leveraged buyout and why private equity firms are able to produce such large returns. Rather than just sitting back, private equity firms are always trying to grow the companies they have purchased. Once they have grown the company, they hope to be able to resell it to another investor at a higher price than what was originally paid for it, and thus make a profit. The primary means by which they attempt to grow the companies they purchase is through the use of two methods. Organic growth. The first method by which private equity firms attempt to grow the companies they acquire is through the use of organic growth. This is achieved when private equity firms utilize their majority ownership stake in the acquired companies to hire executive management personnel who have a history of maximizing returns for investors and then implement strategies such as marketing and the hiring of sales teams to expand the user base of the products or services provided by those companies. Acquisitions of similar companies. The second method by which private equity firms attempt to grow the companies they have acquired is by utilizing more leveraged buyout strategies. For example, if a private equity firm purchases a software company, Company A, providing social media marketing tools for $10 million, and the owners of that company decide to utilize their acquisition funds to purchase another software company, Company B of similar size for $10 million, both of those companies would now be owned by the same private equity firm. However, assuming that the debt associated with the acquisition of Company A had previously been paid off, the private equity firm could use the debt of each company to leverage one another and allow the combined entities to be larger than either of the individual companies were prior to being acquired. In this scenario, the combined company would continue to operate in a manner identical to how the two separate companies operated prior to being acquired. But the combined company would now have increased operating scale and therefore greater potential for profitability. At the end of the day, the combined entity's increased profitability would be used to repay the debt associated with the leveraged buyout of each of the companies. As the debt associated with each of the individual companies is repaid, the value of the combined companies increases, and thus the private equity firm can potentially exit its investment in the combined companies at a higher valuation than what was paid for each of the companies individually. You've learned a little bit about private equity now, so ask yourself this. Is private equity the true cause of the retail failures of some of these major retailers going bankrupt? No doubt the answer is very clear. What possible reasons would private equity firms have to intentionally bankrupt companies, fail in making good on their buyout debt obligations, and ultimately destroy the trust with their own investor base? There are none. Private equity has one single objective: to advance or grow companies. As such, when acquiring these major retailers, their plan was to fix, rebuild, and be profitable again. Why then were these companies allowed to file for bankruptcy? Gerald Storch, former CEO of Toys R Us, commented on Senator Elizabeth Warren's statements in this manner. The internet, e-commerce, and Amazon are destroying these retailers. In this case, private equity is clearly not the likely bad guy here. Convenient shopping and Amazon have clearly made it impossible for many of these retailers to compete and exist. Thanks for watching. If you liked the video, don't forget to hit the like button.